Good afternoon, everybody, and welcome to TradeStation. My name is Michael Burke. I'm Vice President of Client Training here at TradeStation, and I want to welcome you to another edition of our Art of TradeStation series. This series of events is designed to highlight some of the more powerful features and customization capabilities of the TradeStation desktop platform using easy language. In today's session, I'll be talking about those things you need to really understand about volatility. And I'll be sharing some of the custom tools for measuring volatility and scanning for volatility opportunities that I use in my own trading. Keep in mind that the following presentation is for educational purposes only. All of the symbols and trading ideas discussed are for educational purposes and are not recommendations. Active trading is not suitable for everyone. Options trading and futures trading carry a high degree of risk, and you can find additional disclosure information on our TradeStation website. If you're new to TradeStation and you're looking to get up to speed really quickly, I would highly recommend that you check out the Getting Started training channel, which is presented by TradeStation Securities and hosted on youcantrade.com, which is an affiliate of TradeStation Group. There is something to learn there every day. There are live sessions, lots of great videos, so definitely check it out. It's a great way to get up to speed with TradeStation really quickly. And once you've got those basic skills of TradeStation under your belt and you're really ready to kind of grab the whole TradeStation experience, you might want to check out Masterclass. In the past, we used to do Masterclasses as in-person week-long immersion sessions. So you'd come Monday through Friday to the corporate office and we go through TradeStation and all the different features and functions, easy language, strategy trading, all within a week. And the online masterclass kind of feels like that because we cover all things TradeStation and trading, and you can attend live sessions or watch archive videos, take courses. There is advanced technical white papers, all kinds of things, special guest speakers. So lots of things to tap into. We even offer twice a week live Q&A sessions where you can come in and ask the TradeStation experts anything you want to ask them about TradeStation. So all of that's included with the membership. There's a 14-day free trial to check it out, and then it's just $59 a month after that. So today we're going to talk about the different types of volatility and how you can measure volatility to see if the options that you want to trade are overpriced or underpriced based on the historical volatility of that particular underlying asset. We can also use volatility to find opportunities. If we are buying options, we might want to scan for low volatility options. And if we are writing spreads or writing options, we might want to look for those underlying instruments that have high implied volatility. So we'll go through some tools that allow us to do that kind of opportunity scanning as well. We're also going to talk a little bit about being aware of what's going on with a stock before we put on an options trade. So one of the ways that options traders very often get in trouble is by not paying attention to what's going on in the market. They may not have remembered to look to see if there's a dividend, ex-dividend date coming up, or when the next earnings date is for a stock. Those kinds of things can really affect volatility and option prices, and you need to be aware of that. I'm going to show you some tools in TradeStation that can keep that kind of information right at your fingertips. So let's get some fundamentals out of the way. The price of an option is made up of a number of different market factors and elements. The two main factors are intrinsic value and time value. Intrinsic value is the part of the option price, which is the difference between the strike price of the option and the current price of the underlying asset that you're about to trade. So think of intrinsic value as how much is your option in the money. And it's the difference between the strike price and the current price. And of course, it depends on whether it's a call or put. The second part of the option price is time value, which is primarily made up of two key elements. Obviously, the time until expiration is a key element, and then volatility, which we're talking about today, is also one of the key factors in your time value. So together, intrinsic value and time value work together to come up with the price of the option. And you can see these prices and these volatilities for each options in an option chain like in OptionStation Pro. So I think the important thing to get here is that there are two types of volatility that options traders look at. First, we look at historical statistical volatility, which is based solely on the price movement of the underlying asset. That calculation uses a standard deviation method, usually looking at 30 historical daily bars to estimate an annualized price potential, or if you think about it, maybe the potential risk of the underlying asset for a specific period of time. And in TradeStation, that calculation is an indicator, which is called volatility standard deviation. You can plot that on a chart. Keep in mind that that needs to be on daily bars only. It's a daily bar type calculation. Historical implied volatility is derived by calculating first the raw volatility for each of the options in an option chain. So, every underlying asset has a number of options that trade, and each of those options have their unique price based on the strike price and days to expiration and volatility. And so we can take that option price using the pricing model and back out what the implied volatility is. And that can be really important because implied volatility gives us a lot of information about what the market is thinking. So we start out with these raw implied volatilities for each option in the chain. But there's not a lot of historical data for each option in the chain. And so we want to kind of get an overview of what is the current situation for the volatility for this particular underlying asset. So there was a concept that came up a long time ago. It was developed by the Chicago Board of Options, and they created a concept called VIX. And so VIX takes those raw implied volatilities for the options in a chain. It looks at certain types of options in certain expirations, and it weights them and averages them and comes up with a value which we call VIX. So we have long-term charts of volatility that we can do analysis on. And of course, VIX is the volatility index that the CBOE produces as a symbol that we can add into a chart. In fact, there's a whole series of those now on all the major markets. It's not just the VIX on the S&P 500, but there's one for the NASDAQ, and there's one for the Russell, and the one for the Dow, and there's even VIX for gold and silver and oil and all those kinds of things. So we have a lot more data at our disposal now than we've ever had before. And many years ago at TradeStation, we realized that this was really incredibly powerful information that options traders needed. But what they really needed was this data on each stock. So what we did is we added a mechanism to our data network where every night we look at the options. It's very similar to what VIX does for every optionable stock, and we calculate a daily implied volatility VIX for every stock. And so you can look at the implied volatility of Apple or GE or Ford or any stock that's optionable. You can plot a daily VIX number for just the options for that stock in TradeStation. And this is incredibly valuable. We can do lots of different analysis. I'm going to show you how I look at that data and how I analyze that data for opportunities. But we can also compare that implied volatility for each stock to its historical statistical volatility, which we just talked about. So we can look at the price potential using statistical volatility and compare it to implied volatility. And remember that implied volatility is the price of the options, right? We're getting that from the options. So if implied volatility is higher than the statistical volatility, then that's telling us that the options are a bit overpriced compared to the price potential of that underlying asset. And if the VIX or the implied volatility of that stock is less than the historical statistical volatility, then that's telling us that the options are underpriced based on the current price potential of the underlying asset. So that can be very valuable. And so one of the workspaces that I'm providing in that zip file is a workspace that does just that. It has an indicator that shows you the comparison between historical statistical volatility and historical implied volatility. So the first thing I want to show you is those raw implied volatilities in an option chain. So here, if this is OptionStation Pro, I'm looking at eBay up here. This is the October 23rd expiration. You see the strike price is running down the middle, calls on the left, puts on the right. And I've highlighted these two columns. This is the implied volatility for each option based on that option price. So Normally, you plug volatility into the pricing model and it gives you the price. In this case, we're reversing it out. We have the price, but we want to know what the implied volatility is. So when you think about how options are priced in today's market, right? It is still a market maker-based system. Market makers are still providing liquidity. There aren't enough traders in the retail world to provide liquidity for all strikes and all series. And that's why you can go into and buy or write almost any option or any option spread, because there's market makers taking the other side of that trade. And so those market makers are really in tune to the risk associated with their activities. And so they're the ones who generally are controlling and setting prices. And so when we look at that column of implied volatility, it's telling us kind of what that market maker is thinking. And so if volatility is rising, they're thinking the market is getting more risky, more downside potential. And if volatility is falling, they're feeling comfortable. They feel like, the market is stable. It's, and the market is tending to trend higher. So looking at implied volatility is really important. It gives us an insight to what the risks are and what the sentiment of risk is among those traders who really control these markets. Some of the characteristics of implied volatility that you need to be aware of. As I've said, implied volatility is based on the prices of the options, and it's based on the market prices, driven primarily by market makers and their perception of risk in the market. And as I said, the market makers are such an important aspect of options trading, because otherwise there just wouldn't be the availability of all of the strikes, all of the series that we could trade. And so market makers do an important job in the options trading world. And of course, these are experts in this field, and they make a living making markets. And so they're going to adjust the risk and the prices of the options based on what their activities are, what they're doing. And so we want to pay attention to that. And we can pay attention to that with implied volatility. What is that implied volatility number actually telling us? What does that percentage represent? And it represents an annualized price potential. So they're looking at those options and they're saying, okay, what is the potential for this particular instrument to go up or down over the next 12 months? What is that percentage? And so when you look at implied volatility, that's what you're looking at. And of course, you can take that annualized number and then slice it down into smaller slices. So if I have an annualized number for volatility, I can say, okay, what is the price potential for 30 days or 60 days or 90 days using that number? So we can do some math with that number and then project a number of different price ranges for an underlying asset based on implied volatility over some period of days. You may have heard of the term expected move, right? So we calculate an expected move between now and expiration. That's based on that implied volatility number. So it gives us a measurement of the risk sentiment. Higher volatility means higher risk. There's a bigger chance, or there's a sentiment that they think the market has a chance to correct or to trend down. And so, and again, we look at the trend of volatility as well. It's not just the number, right? Because you may have a stock that constantly has a very high volatility number, but is that number going up or is that number going down? That's what we really care about. What is the trend of that volatility number? So one of the important aspects of implied volatility that you have to understand is that volatility is generally oppositely correlated to the underlying price trend, which means, and again, we kind of chatted about this a moment ago, when the market is trending up, implied volatility tends to go down. There's less risk for the market makers when the market is making constantly new highs and trending upward. You see implied volatility rise when the market is falling, or there's a greater perceived risk in the market that it may be falling in the near term. So we always look at the trend of that implied volatility number. And we can do that with VIX, which comes from the CBOE, or we can do that with the TradeStation VIX for each optionable stock. And that's an incredible feature to have at TradeStation. Here in the bottom right of the slide, you'll notice that this is one of the workspaces that is in that zip file that I put into the chat. In the early days of options trading, when I first started trading options, I didn't have a lot of the same data tools that I have now. One of the tools that you would look at if you were trading, let's say, SPX options, or you were trading the E-mini futures or the big futures contracts for major markets, you would look at VIX and you would compare that VIX number to a statistical volatility of that underlying asset. And so we can plot those two values on a daily chart, both the statistical volatility and the implied volatility. And when implied volatility is greater than statistical volatility, that tells us that the options are a little bit expensive compared to the price potential of the underlying asset. And when implied volatility is less than that statistical volatility, then options are underpriced for that particular price potential. So if you think about it, you want to buy options that have low volatility, that are underpriced, because volatility typically goes back to the mean. So even if the market moves sideways, but volatility went back up to its normal level, those calls and puts that you're long would increase in value. And we typically want to write or be short options that have high volatility, again, because we expect that volatility to come back to the mean. But there are a lot of moving pieces here that you have to be aware of. Why is volatility so high to begin with, or why is it so low to begin with? So there's a lot of moving pieces here, and we're going to try to go through some of those factors that may be driving that volatility. So this is the workspace. It has a radar screen on the left with the comparison indicator as well, because we can use this comparison not only on one stock in a chart, but we can put it in radar screen and look for those particular unique stock symbols that may be underpriced or overpriced. And we can actually use a ratio of these two values to see which ones are most overpriced or most underpriced by sorting on those columns. So the blue line in the chart is the statistical volatility based on the underlying price. And then the implied volatility is the VIX number that we're calculating. In this case, we're calculating it for IBM. So this is a daily chart of IBM. And the red line that you see there is the implied volatility, that VIX calculation for the options just for IBM. And we can compare those two together. So here, if you look at the status line for this indicator, it shows you the legend for the two colors. So implied is red, statistical is blue. And you can see that when implied is greater than statistical, it tells you right here whether it's overpriced or underpriced. In this case, the implied is above the statistical, so that's overpriced. Same calculation in radar screen, except I'm calculating the ratio between those two values here, and we can sort on that. Otherwise, you can see the implied volatility in the statistical, and it gives you that same rating, whether it's overpriced or underpriced here in radar screen for each symbol. So my thinking has changed a little bit over the years. To be honest with you, I don't look at statistical volatility that much, as much as I used to. Nowadays, since I have all of this great implied volatility data historically, I pretty much focus on just the implied volatility. And there's a number of different ways that we can look at that implied volatility in order to derive whether options are overpriced or underpriced. The first thing I want to show you before we go into that is the idea of analyzing implied volatility for those indexes that come from the CBOE. So the CBOE has the VIX index, the volatility index. It has one for NASDAQ and Russell. And what I wanted to do is I wanted to take those data streams and I wanted to analyze what's going on with implied volatility with VIX. What is the percentile of the current value of VIX over the last 60 days? Or where is VIX within its highest, lowest range for some period of time? What is the ratio between VIX and the average VIX? All of these values can tell me whether or not options right now are overpriced or underpriced. Without looking at the statistical volatility, I have enough information with the implied volatility to tell me whether I should be buying options or I should be selling options. So the tool that I'm going to show you here allows you to put this indicator on any chart, and there's an input for the volatility index that you want to analyze. Now, the great thing about these indexes is that you can look at them on daily charts. You can also look at them on intraday charts. So the TradeStation volatility does not work on intraday charts. It only works on daily charts, but the VIX indexes from the CBOE do work intraday. So you can do intraday analysis of implied volatility. It's really a powerful feature. Point here, if you notice at the bottom of this slide, there's a really great white paper produced by the CBOE that explains what VIX is, how it's calculated, why you need to care about VIX. So first things first, this is what we talked about a little bit earlier. In the top of the chart here, this is the SPX index. This is the cash index of the S&P 500. And in the bottom is the CBOE VIX index. This is $VIX.X. That's how you get it into a chart. This is a multi-data chart in TradeStation. It has 2 data streams. But the key thing I want you to see here is that oppositely correlated concept. So here, when the SPX is moving up, it's been moving up from July through September. Notice how you have a corresponding downward trend in the VIX during that same period of time. Now that correlation gets a little bit out of whack sometimes when there are large price movements in the SPX. So the VIX sometimes takes a little while to adjust. Sometimes the VIX overreacts to price moves. Sometimes it underreacts to it. But in general, you see this opposite correlated action. So I wrote an indicator that analyzes VIX. Not only the VIX indexes from the CBOE, but the VIX that comes with TradeStation for every optionable stock. And I look at VIX with 3 indicators, and they're built into one indicator. And I want to look at the average ratio, which means that whatever the implied volatility is historically, I want to put an average on that implied volatility, and I want to see how far the current value of implied volatility has strayed away from that average. And so I calculate a ratio for that. So the farther it is away, let's say it's farther away to the upside, those options are way overpriced. And if it's way far away on the downside, those options are way underpriced. And so I want to know that. And I want to be able to scan on a list of symbols to see which ones are most overpriced and which ones are most underpriced. And so we'll look at that. But right now I'm focusing on those VIX indexes from the CBOE. So the average ratio is one of those indicators that I want to look at. I also want to look at the percentile. So percentile is a concept of where is the current implied volatility versus some number of historical data points. Maybe it's the last 60 days. So if today's current implied volatility is higher than 70 out of the last 100, that would be the 70th percentile. And so that's something we want to look at. Implied volatility in higher percentiles means typically that the options are overpriced. And percentiles that are close to 0 or 10 or 20 in the lower percentiles, those options are underpriced. So we can measure that overpriced, underpriced concept with percentile as well. And finally, so a concept that I developed just in the last couple of months is putting implied volatility information into the Williams percent R indicator. So this is like a stochastic or RSI, Williams percent R. They're all the same thing. They kind of measure where implied volatility is within the range of some number of bars, within a price channel. And so if the implied volatility is in the upper level of percent R, then options are overpriced. And if it's in the bottom, it's underpriced. And so that's the concept. So I look at it with those 3 indicators, and you'll see that. You're probably wondering why I'm using 3 different indicators to calculate pretty much the same thing. And the reason is that options traders typically look at percentile. And percentile is the one that I like the least of all 3 of these. I really like the average ratio the best, but most options traders have heard educators and have seen books where they talk about percentile. And percentile is very valuable, don't get me wrong. But I don't think it's the best measure for whether something has high volatility or not. And I think average ratio is the best for that. So I wanted to include all of them so that however you feel about looking for this type of information, overpriced, underpriced options, you have all 3 of them here in this indicator. So the interesting thing about this indicator is that I'm accessing the volatility index programmatically. So you don't have to create a multi-data chart. These indicators are really easy to use because you can just insert it on any symbol, make sure that you have the input set to the correct volatility index that you want to use, and then it will plot that information. And we'll look at this in TradeStation in a minute. But take a look at the bottom chart here for a second. This is SPY on a 60-minute chart. And this is the indicator that I'm providing in that ELD file. There's a workspace that's associated with this. And these are the inputs for that indicator. But the key input here is that very first indicator is the symbol for the volatility. And when you put that symbol into the input, then the yellow line that you see here is the VIX. And so that's the close to close VIX. And then you see the bars, the high and low for each of those days there as the high and low. But the yellow line is the VIX itself. So here you can see the price channel of the VIX. The blue line is the highest high over the last 63 bars. That's also an input. You can change how many bars you're looking back. And then the magenta line is the lowest low. And the orange line that you see running through there, that's the line that I care the most about. That's the average. That's the average VIX over some number of bars. In this case, it's also 63 bars. So how far the VIX is above or below that average is what I care about. And that is the average IV ratio. It's the yellow number that you see right here. So it is 7% roughly above the average for SPY right now. This is a 60-minute chart. To the left of that, you can see the percentile. So today's volatility at the close was in the 88th percentile over the last 63 bars. And you can also see the Williams %R value for that implied volatility. It's at 73%, which is near the, if you think about it, at the top of that, it's near the overbought area of that oscillator. So those are the ways that I look at implied volatility. Now I have 3 different ways of measuring whether options are overpriced or underpriced. And I typically look at that middle value to see how far the implied volatility is right now with the average implied volatility, because I have an expectation that it's going to revert back to the mean at some point. So those options are overpriced. You can see that indication here. The mode of these options for SP right now are overpriced. So in the chart above, it's the same concept, except I'm looking at a daily chart of the QQQs. Notice that the input here is a little different. This is the volatility index for the QQQs. It's $VXN.X. So that's the VIX for the Qs. And we're doing the same analysis, exactly the same analysis. It calculates the same indicators, and it tells us whether it's overpriced or underpriced. So here in Radar Screen, I've given you the list of volatility indexes that come from the CBOE. And these are the different values that you can plug into this indicator, and you can change the underlying asset. But that's the idea. The idea here is how far has the VIX moved away from the average, or what is the percentile of VIX right now over some number of bars, or where is it within the price channel? So those are the concepts. You'll also notice here that I have 2 dotted lines. And these dotted lines are the way that I think about support and resistance for VIX. So let's go back in time about 3 or 4 years ago, when the market was moving up steadily and VIX was incredibly low. It was usually under 12 or 15. In fact, 15 VIX would have been extremely strong resistance. It would have been very difficult for the market to, or volatility at that time, implied volatility, to really go much above 15. The price action of the market, whenever volatility kind of went up a little bit, the market had a little bit of a pullback. You'd see VIX kind of spike up to 15, but it never really went more than that. Occasionally it would go to 20, which was incredibly overbought at that time. And then it would come back and revert back under 15. And so I always have these little dotted lines at those levels where I think support and resistance are, and those are inputs, so you can put them wherever you want. Right now, I have moved those 2 values, which used to be 15 and 20. I now have them at 20 and 30. And so I think 20 right now, which is crazy, but it's true. I think that support for VIX is probably around 20. We haven't hit that in a long time, by the way. So that may be just wishful thinking on my part. But I also have it set at 30, which I think is a really good resistance level for VIX. And you can see that we've touched 30 a few times, and it usually bounces off of that. So I'm hoping that once we get through this election craziness, that next year, the markets will come back to a normal mode, and we'll see VIX back at normal prices. We'll see. So that's the idea. Now take this exact same concept and put it on the implied volatility for an individual stock. That's the next thing we're going to talk about. So as I said, TradeStation created this mechanism within our data network where we look at every optionable stock. We do a batch process every night. We open up every option chain. We grab the raw prices, average them, and come up with a daily VIX number for each optionable stock, ETFs as well. This data, though, is only daily data. You can put it on a daily chart, a weekly chart, or a monthly chart, but you can't put it on an intraday chart. And again, we're going to look at that percentile calculation, average ratio, and percent R measures. And of course, we can drop this into radar screen. And so now I can sort a list of optionable stocks by percentile, or by the percent R, or by average ratio, and see which stocks are the most overpriced or underpriced. And that's a great thing to check before you put on an options trade. So on the right is the chart. And so now the inputs for this indicator are a little different because I don't need to specify a symbol because it's just looking at whatever symbol is in the chart. So this is a daily chart of Apple, and it's looking at that implied volatility data, which is the red line here. And then the white line is that average. So I'm going to calculate that average IV ratio right there. And I can see that we're 20% above that average right there. We're in the 77th percentile. We're at the 46% level of Williams percent R. So I thought it would be interesting if I'm going to calculate this percent R and put it into this indicator that you might want to see that indicator as a standalone indicator. So this is percent R of implied volatility, and it's a standalone indicator, and you can set the look back length. So if you're wondering how this is derived, I gave you an indicator to play with. So here you can see that this is the percent R for 30 bars, and that value is 46 right now, and it's 46 in this indicator. It's the same calculation, of course. And so again, we're looking for the percent R, whether it's overbought or oversold, just like we would if it was looking at the prices. And so, but this is telling us whether it's overbought or oversold of the implied volatility for the options for Apple. That's the concept here. Also in this chart and in this workspace, I have included the last several earnings reports. You can see that historically in a chart with a show me, so I'm just kind of showing you that here. And I'm going to show you how you can see where the next earnings date, when that's coming. I'll show you that tool here in a second. That's a brand new tool that we just created and put into the App Store. It's free. And you can go to the App Store and download it. It'll tell you when the next earnings date is for any stock. So if we take this indicator and put it into the radar screen, we can see the ratio. There's that ratio between the average and the current value of IV. I can see what that IV value is now, the high and low over some period of bars, the average, and then I can see the Williams percent R value, and then there's the percentile. And right now, I'm actually sorting by percentile. You see that little down arrow right there? That's telling you that I double-clicked on that subcolumn, and I've sorted the list of symbols by that percentile. So here I'm looking at those stocks that have the highest percentile of IV right now on this list of stocks, which is the Dow Jones Composite 66. So by sorting on any of these columns in radar screen, I can rank these symbols by their implied volatility analysis. Okay. The fourth workspace that is in that zip file is a workspace called Earnings and Dividends. It's important as an options trader to know what's going on in the market, especially if you're going to trade a stock. You need to know, does that stock pay a dividend, and when is the ex-dividend date for that stock? You know, if you're going to trade a stock, when is the next earnings date for that stock? A lot of traders, they're doing their analysis, but there are a number of moving pieces whenever you place an options trade. You know, volatility is one of them. What is the volatility of the stock? Is it super high or super low? I need to know that if I'm writing or buying options. Is there a dividend? Now, I'll have to be honest with you. I don't think dividends are a giant factor in options trading. Many stocks don't even pay a dividend, but there are stocks that pay a significant dividend. And that significant dividend is going to affect the price of that underlying asset on that X date, right? We're going to the stock is going to adjust the price of the stock by that dividend. And so I'm going to show you a tool where you can see whether the stock you're trading pays a dividend. But you need to learn more about how dividends affect your options trade. But probably the most important factor in options trading, in my mind, is when is the next earnings date? Because earnings dates have an incredible effect on volatility. As we get closer and closer to an earnings announcement, you typically see the option prices go up, because as we get closer to that date, there's more and more uncertainty to what's going to happen on that particular date. So anywhere from 15 to 20 trading days prior to an earnings announcement, you're going to see volatility spike up during that period of time. And as soon as the earnings announcement is over, whether it's good news or bad news, the volatility is going to go back down to a normal level. So think about that for a second based on the type of option position you have on. Does your option position benefit or does it get hurt if volatility goes up over the next 2 weeks? And what happens after that announcement? When does your options expire within that cycle? So all of those things are so important. So you need to know when that next earnings date is. And we created a tool last month and put it into the store that displays when the next earnings date is. You can display that in a chart, or you can display that in radar screen. But you have to download it from the store. There's also a link to that in the PDF PowerPoint. You can access it from there as well. So this is the workspace I want to show you. So on the right is just a regular chart, and just for fun, I put the volatility %R indicator at the bottom there. So that's the Williams %R IV indicator, just so I have something down there. You can see the earnings announcements on the bars there. This is eBay, a daily chart, and in the upper right-hand corner, it tells me when the next earnings date for eBay is, which will be October 21st, and it tells you that it's going to be after market, 1600. So that is really great to know. So that is about 3 weeks out. So if I want to, if I'm going to buy options now, I know that somehow over the next 3 weeks, I'm going to get, I'm going to get a little bit of a boost in volatility. Take a look. You can kind of see it a little bit here. Notice that there is an increase in volatility right here near this earnings. There wasn't one here, but there was one here. And so you often see these kind of spikes. Here the market's been moving up into earnings, but here, this is what's important. You can see that the implied volatility is near the top of the channel as we go into that earnings. And then what happens right after that earnings report? Volatility collapses and goes back down. And so you see that quite a bit in these charts. That's the key. So you can put that same next earnings date indicator that you see up here in the top of the chart, so you can insert that into a chart, or you can put it into radar screen. And so here on a list of symbols, I can sort by those stocks that have the next closest earnings date, and whether it's in the morning or whether it's in the afternoon, pre or post market, I can see the time of the announcement. Confirm simply means that the company has confirmed that in fact they are going to do their announcement on that day at that time. A lot of times they'll set it, but they haven't confirmed it yet. So you still get the information, but it's not completely confirmed yet. And then, of course, we just calculate the number of days out there, so you can see that as well. And then on the right of that is the dividends. So here, if you're going to put on an options trade, just as a sanity check, take a look at this and see when the next quarter X date is. So a lot of times you can see these are all in the past, so they have not announced their next dividend, so you're going to see the past one. But here you can see that there is going to be a dividend date here of November 9th. You can see what that dividend is going to be in cents. So, this is an $80 stock that's going to adjust about 32 cents on that date. So that's not really super significant, but at least now you know that, right? And so if you are writing options or buying options, but primarily if you're writing options, you have to be careful, because if somebody exercises against you, it's really possible that you might be responsible for that dividend. There's just a number of different aspects of that you have to pay attention to. So again, I encourage you to learn more about how options trading and dividends work together. So that's the fourth workspace. So those are the four workspaces: the implied volatility versus the statistical volatility, the volatility analysis on VIX, the volatility analysis on an individual stock, and then this workspace, which has the next earnings and the dividends for you. So those are the four workspaces. They all come with custom tools that are in that ELD file. So, if you're new to TradeStation, you have to install the indicators first. You just double click on that ELD file, it'll start a wizard, and you just click next and finish, and then you can open the workspaces. Okay, let's go to TradeStation. All right, let's work backwards. So this is the workspace that has the earnings and dividends and the indicator. Now this indicator comes from the store. So when you subscribe to this indicator, make sure you subscribe to this indicator before you open this workspace, because otherwise you'll get an indicator saying that that indicator doesn't exist. Even if that happens, what you can do is to get that indicator into the chart or to get it into TradeStation, you're going to go to Apps and you're going to go to Trading App Store Updates. So there's a couple of trading store icons in here, but the one you want is the updates. And then you can come down here to next earnings date. So this is after you subscribed. And you just click on launch, and it will launch a workspace that comes from the store. And then in your list of indicators, you'll then have an indicator that you can add to the chart. This is Add Studies. And if you come down to next earnings date, you'll see this little icon here to the left. That tells you that comes from the store. That's next earnings date. And you can add that into any chart, or you can add that into Radar Screen. And that's how that works. So here in Radar Screen, I can sort by any of the columns. Here I'm sorting by symbol now. And so I can see that Apple is going to have an earnings date on the 28th of October in the afternoon. It's tentative. That's 34 days out. If I sort on the number of days here, I can see which stock in my list. And again, I can add up to 1,000 symbols here in Radar Screen. But typically, I'm looking at the symbols that I trade the most. They're usually typically high volume, more liquid kind of stocks. So, here we can see that Micron is 5 days out. Notice that we've gotten these spikes in volatility leading into that. You can see the spike in volatility leading up to there, the spike in volatility leading up to there, and then that collapse. That is a really consistent pattern of implied volatility that you can use to your advantage if you can measure it like this. So I think that's very helpful. And again, here in the dividends column, we can see those stocks that have dividends. If I sort on this, where those next dividends are. All right, let's jump to the volatility compare. So this was the first workspace that I showed you. This is the implied volatility, the red line there, and the blue line is the statistical volatility, and we're measuring which one is above which one. So here we're looking for implied volatility. If it's above the statistical, then we know that that's overpriced. We can see that here in the legend here. And if it reverses the other way, then we know that they're underpriced. And I can also see that in Radar Screen. So what's cool about Radar Screen is I can sort by the ratio between these two symbols. So I can see which symbol is the most underpriced or overpriced by just sorting by that. So here, for example, Intel. You can see that that's a pretty big gap there between that's a 71% gap. The implied volatility is that much higher than the statistical volatility. So you can sort by any of these values. It also makes a nice sentiment indicator. When there's more overpriced, the market is typically in a bearish mode. And when there's more underpriced, the market is typically in a bullish mode. All right. So anyway, this is just a VIX chart that I put into this workspace just so you have it. It's a multi-data chart. This is the SPX, and this is the VIX, and you can kind of just scroll through this historically and kind of see that opposite correlated concept. Here, this is March. You can see volatility rising as we were falling through the market. We hit those highs of implied volatility, and once the market started going the other way, we can see that volatility falling. So it's a very classic oppositely correlated concept here for VIX. So let's focus in on this chart here. So this is the Qs, and this is the indicator that analyzes the VIX for the Qs. And the way it analyzes the VIX for the Qs, I'm going to double click on that line. That takes me to Customize Indicator. Here you have to specify which volatility index that you want to analyze for the symbol in the chart. So since I'm looking at the Qs, I want to look at the volatility index for the NASDAQ 100, which is the symbol $VXN.X. And so that gives me that volatility, and I can analyze that in comparison to the QQQ. Now I have this kind of exaggerated, but that's the idea. And so here I can see what percentile the VIX for the Qs is in. What is that ratio between the average? Remember, when this is a negative number, options are underpriced. When it's a positive number, they're overpriced. It's an important concept there. And then the Williams percent R, where is it in the channel? It's at the 67% point of the channel. That channel being the high and low here. And again, if I double click there, you can also set those support and resistance levels. Remember I was talking about, I used to use a 15 and a 20 support and resistance level for VIX. So here you can set those levels right here, and it'll draw those little dotted lines. So wherever you feel like that support or resistance is. For the Qs, it's not 20. I can promise you that. It's probably closer to 30. And I would probably say 40 is resistance. So let's plug that in. I'm going to say the low support is 30 and the high resistance is 40. And that looks like a better fit, doesn't it? And finally, this is the workspace that started this whole thing. This was the first workspace I ever built for analyzing volatility to take advantage of that daily implied volatility for every stock many, many years ago. And it's evolved over time. Obviously, it certainly evolved over the last 60 days because I added that Williams percent R concept here. Here, it's the same concept. The red line is the raw implied volatility each day. This has to be a daily chart. I also have the earnings points in there just because I like to look at those. I've also added that Williams percent R of implied volatility at the bottom here, which is equivalent to this value here within this indicator. You don't need them both on the chart, obviously, but this is a fun indicator to look at to just kind of verify what's happening here and to look at it historically as we go into earnings. And then all of those concepts for this indicator here are available in radar screens. So this indicator in the chart is the same indicator here as radar screen. It shows you the ratio between the average and the implied volatility, and I can sort on that to see which stocks are the farthest excursion, either above or below the average. And you can see that when I do that, you can see that underpriced and overpriced values. So a lot of these are underpriced right now. So there's the implied volatility now, the high, low, the average. There's the percent R, and there's the percentile. I can sort on any of those values. And those are the custom tools that I'm providing here. So volatility is the Greek risk factor called vega. And so when you're looking at an options chain and you're trying to figure out how will volatility affect the price of my option, if I'm expecting volatility to go from 20 to 30, that's 10 VIX points. Well, how will that affect my option price? Now, there's a lot of moving pieces here, and it's dynamic. As VIX changes, all the other factors change, so it's not linear, but it gives you a guide, right? So for every 1% change in volatility, vega tells you how much your option price is going to change. So vega is always a positive number for long calls and long puts. So if you're long a call or you're long a put and volatility goes up, your call and your put are going to go up in value. That's the idea. If you're short, they're going to go down in value. And vega always moves toward zero nearing expiration. So volatility is one of those key factors in time value. And time value decays as you're nearing expiration. So vega is going to go down over time. You can see that here in the chart. As we get closer to expiration, you can see those VIX values go down. You can also see they go down as you get farther away from at the money. So volatility is at its strongest point for those options that are farthest away from expiration and those that are at the money. So that's what this is telling you. So at the money options that are farther away have the biggest effect on volatility on the option price. Okay, some key takeaways today. We're going to try to buy options that are underpriced, calls and puts. So when we see that options are underpriced, those are options that we typically want to try to buy. When we see options that are overpriced, then we want to write those options or write spreads using those options, covered spreads, so that we take advantage of the fact that volatility is probably going to come back to the mean. So if volatility is high and I write options and volatility comes back to the mean, that's good for my position. We're always going to be looking for volatility that is making new highs, because as volatility makes new highs, as volatility rises, that's an indication that the market makers are perceiving a higher degree of risk. And if they're perceiving it, then we better perceive it as well. Remember that volatility rises into earnings. Make sure that you know when the next earnings date is for any position that you're trading. Make sure you know what the dividend is, if there is a dividend, and when that next ex-dividend date is. And now you have some tools to also check whether volatility is overpriced or undersold. Those are all good things to do before you put on an options trade. So here you have my email address. And again, this PowerPoint, I created a PDF and it's in that zip file. In that zip file is also a easy language ELD file, which is a compressed file. You have to install that and install the indicators in that ELD file before you open the workspaces. Then you can open the workspaces. But you should also download the next earnings date tool, because a couple of my workspaces may have that tool and may be expecting that tool. If you get an error with the next earnings date, don't worry about it. Just go to Add Study and add the next earnings date into the chart or radar screen. And of course, you have the PowerPoint to review. There's the link to the zip file. There's the link to the next earnings date. And as I said earlier, I'm the head coach for Masterclass, which is a really dynamic and fun community as we talk about all things TradeStation and trading. I do live sessions every day, Tuesday, Wednesday, Thursday. There's courses that you can take, and there's a 14-day trial. I highly recommend to take the trial, sit in on some sessions, see if it's right for you. There's no risk. Send me an email if you have any questions. Thanks, everybody. Again, have a great evening. We'll see you at another upcoming TradeStation event. Thanks, everyone.